Hello everyone, this is Keertana, Assistant Professor, Department of Commerce. Today I am here to present a lecture series on the subject Financial Management on the topic Cost of Capital. First we can see what is cost of capital. Cost of capital refers to the cost of a company incurs to finance its operation, investments or projects through either debt, equity or a combination of both. It represents the return that investors expect from their investment in the company, which is also the minimum return of the company must earn on its investments to satisfy its creditors, shareholders, and other capital providers. The cost of capital is used by companies to evaluate investment decisions and determine whether a project or investment is worth pursuing. It is an essential component in financial management as it helps in the decision making process related to financing, budgeting, and risk management. So the cost of capital, actually first we have to refer the cost of a company, which includes operations, investments or projects either in debt, equity or a combination of both. It represents the return that investors expect from their investment in the company. Also, we have to satisfy creditors, shareholders and other capital providers. The cost of capital is used by companies to evaluate investment decision and determine whether a project or investment is worth pursuing. So first is components of capital. So actually in last video we have seen that in short form. So we can see in elaboration there are several components involved in determining the cost of capital. First one is cost of debt, cost of equity and last is weighted average cost of capital. First we can see what is cost of debt. The cost of debt is the effective rate a company pays on its borrowed funds such as bond or loans. It represents the interest expense the company incurs on its borrowings and is a crucial element when determining the company's overall cost of capital. So it is usually lower than the cost of equity due to the tax deductibility of interest payments. Interest is tax deductible in many countries. After tax cost of debt is more relevant because companies can deduct interest expenses from their taxable income, reducing the effective cost. Actually cost of debt we will determine as KD. So it is a process of borrowing funds. Actually it is a process of effective rate a company pays on its borrowed funds like bond or loan. So after tax cost of debt is more relevant because companies can deduct interest expenses from their taxable income, reducing the effective cost. So next we can see is cost of preference share, which is KP. So the cost of preference shares in the return required by holders of preferred stock. It is the dividend rate paid to preference shareholders expressed as a percentage of the current market price of the preferred stock. Preference shares usually have fixed dividends and are senior to common equity but junior to debt in case of liquidation. Next is cost of equity capital, that is KE. So it is the cost of equity in the return required by equity investors, that is common shareholders, for the risk they take by investing in the company. It reflects the expected growth in dividends and the appreciation in the share price. So the cost of equity is usually higher than the cost of debt because equity holders take on more risk, that is there are no guaranteed returns. It can be calculated using models such as dividend discount model, that is DDM, or the capital asset pricing method, which is CAPM. So the next is cost of retained earnings, which is KR. The cost of retained earnings is essentially the same as the cost of equity because retained earnings are simply earnings that are not paid out as dividend but are reinvested in the business. It represents the return required by shareholders on the company's reinvested profits. Retained earnings do not involve new issuance of stock or debt. However, shareholders still expect a return on these funds and it is assumed to be the same as the cost of equity. If a company does not pay dividend and uses its earnings to fund operations or investments, the cost of retained earnings reflect the return shareholders expect on those reinvested earnings. So in summary, we can see cost of debt in the meaning the interest rate paid on borrowed funds adjusted for tax effects. Cost of preference shares is the dividend rate paid to preference shareholders dividend by the market price of the shares. The cost of equity is the return required by equity investors which can be estimated using models like dividend discount model, that is DDM, or capital asset pricing model, which is CAPM. Cost of retained earnings, the return required by shareholders on earnings retained within the company which is equivalent to the cost of equity. Hope the video was useful and understandable. Thank you.